with his best trading performance being $1 million in a single payout.
You have to find something that interests you. There's a lot of strategies out there, and I always tell traders, someone else's strategy isn't necessarily going to work for you. If it doesn't seem intriguing, if you're not curious about how it works, why it didn't work, then you're probably not going to succeed at it. So I got to find something that is interesting to me and resonates with me on the chart.
Now, Vince came into the trading industry not just because he wanted to make money, but to actually clear his debts. Therefore, we uncovered the exact psychology strategies he used to not only make $1 million from the market, but to actually be able to bounce back from multiple six figures in debt.
When the first hour has happened on the day, I have two lines on the chart. I have the IB high and the IB low. When price tests the IB low or tests the IB high, there is a 90% stat that says it's going to reject it. What's interesting is I went and got a poker chip set and I started to stack poker chips on my desk. Every time I had a winning trade, I'd stack the poker chips. Have a loss, I'd take poker chips away. And seeing that visually completely changed it for me. It took that funny, goofy number on the screen and I could sit there and look at these poker chips and say, I'm not giving this back today. I'm going to keep this.
The process of that $1 million payout, was this your first attempt? Was there a lot of blown accounts beforehand? What was that foundations before you embarked on this $1 million challenge?
Yeah, I want to set that stage for you because I think that's the interesting part of how I got there. So,
ladies and gents, welcome back to another episode. We are joined by a man who has achieved a lot, traveled the world a lot. He mentioned he's been living all over the world, Asia and so forth. But the main credential I want to start off with is you've made $1 million in a single payout. What a phenomenal feat. So I think this episode we're going to explore how that was done, the highs and the lows and specific strategies. But first of all, Vince, all the way from the US, thank you for joining.
Thank you for having me.
There we go. So I wanted to first get right into it and kind of understand the process of that $1 million payout and the journey leading up to it, meaning to say, was there a lot of blown accounts beforehand? Was this your first attempt? What was that foundations before you embarked on this $1 million challenge?
Yeah, I want to set that stage for you because I think that's the interesting part of how I got there. So let's back up before my trading days. So I started a company in 1998 and 10x'd it and sold it in 2011 to a company in British Columbia and was in the sheet metal toolbox business. I built toolboxes in the US. After I did that, I went into the import-export business and actually traveled extensively in China, been to China well over 200 times in my career. And that was in 2011 when I actually sold that company. In 2018, I'm in China when the Trump tariffs hit. I had a very large 8-figure contract with a US retailer for barbecue grills, and they canceled that contract because the tariffs essentially added too much to bring them back into the US. So there I am in Shanghai down almost $2 million. Because you had paid fixed costs. Because of the tooling I had put into it. And we had also done the first shipment or produced the first shipment that they were not going to take. And so there I am in Shanghai down $2 million going, how do I recoup $2 million? I had the pressure of the Trump tariffs. And I sat there and I thought, what type of business is out there where I don't have to have a customer and I don't have to have a factory? What business is that? And discovered futures trading. And so that was probably the worst decision of my life.
So before that, you were not involved in the markets. The markets came to you at a bad time.
Traded stock, did some futures, options, but did not do futures.
Okay, so I want to start off with that because a lot of people, mostly people come into the markets. I say from zero in the sense of maybe
I started at sub-zero.
Yeah, you started 2 million down, and
yes.
Even when people start at zero, they're just trying to get a bit of extra cash to pay their bills and so forth, and maybe leave their job. And it's always coming from a place of inspiration and work your way slowly to get towards that goal. You could have been in a state of with these financial anchors, emotional anchors, and when people chase an outcome and you got to pay off these debts, usually the market amplifies behaviors, and that can be a very quick spiral to blowing even more money, let's say. What kind of a mindset did you have coming into it, knowing you were X amount down and you wanted to recuperate it through the markets?
I had a mindset that I was going to make it all back in 30 days.
Oh gosh, okay.
I was going to figure out how to do that.
Okay.
And so the first step that I did is I put a couple grand into a brokerage account and blew it in 60 minutes. That was my first step in futures.
Sounds pretty normal.
And I did that again. I think I actually did that multiple times.
Wow.
And that's when I went out and started to look for any other type of way to get into futures. And that's when I discovered prop.
Okay. And when you discovered that and then you see this big opportunity, like everybody can see in front of them, okay, I get all this leverage, the cost ratio, etc. Obviously, I'm sure there was a big portion of education, understanding risk, understanding your own mindset, because you're coming in as a beginner trader with a huge opportunity and a huge debt, I want to say. What was your roots to educating yourself and navigating yourself through the journey?
So I got on YouTube and I discovered Jim Dalton quite early and started to study market profile. And market profile is something that really interests me, still interests me today. It's something I use heavily. I like how it frames the day. I just like the picture it gives of the overnight session and the day session. And I discovered Fibonacci, took a couple courses on that, and you really use YouTube Academy, right? And a lot of courses.
It's interesting to hear, yeah.
A lot of it was free. I haven't paid a lot by means of buying courses and things. That's everything I did was pretty much come from YouTube.
A lot of people feel that the lack of the reason their profitability is not there is because they lack information. And well, first of all, I don't even believe that's true. I feel like at some point, more information will not arm you further. It might confuse you further or leave you in a state of analysis paralysis, let's say. And sometimes it's better to get out of the classroom and start practicing and implementing. But at the same time, I want to say to them, like, we have the whole world at your fingertips. There's an infinite amount of knowledge. And when I was at university, I wasn't actually learning from the lectures or the textbooks. I was just watching YouTube videos from people that simplified it better than my professors, let's say. The internet raised me. I always say this. It's fascinating to hear. When you were consuming content online, obviously the online information can be a bit broken up and you got to go do a lot of digging. When you're in that mode of being a sponge and kind of taking a lot of information in and converting that towards a working strategy that you were using, what was that process like? Because I think a lot of people, especially watching the show right now, are used to consuming education online on YouTube. How can they take that information and turn it into a working strategy?
Well, you have to find something that interests you. There's a lot of strategies out there, and I always tell traders, someone else's strategy isn't necessarily going to work for you. If you're not interested in it, if it doesn't seem intriguing, if you're not curious about how it works, why it didn't work, then you're probably not going to succeed at it. And so there's a lot of strategies out there traders use that aren't interesting to me. They work for them. They do quite well. They've exceeded what I've done, but they're not interesting to me. And so I got to find something that is interesting to me and resonates with me on the chart.
Why do you choose the word interest? Like, why do you think the curiosity of a strategy is important for the success of a trader?
Well, there's a lot of people that are studying liquidity is interesting to me, and there's a lot of people, study liquidity. It's a deep, dark rabbit hole that I don't have enough interest to really dive into it and fully understand it and utilize it. So to me, it's something that's interesting, but it's not relevant to my style of trading. I watch it, but it's not something that I feel like I need to take the time to do. Fibonacci was something that intrigued me because it's, it appears so much in nature, and I'm going, well, there's something to this. And it was that was intriguing to me and interesting to me from even outside of the world of trading. So how does this work? And it's a naturally recurring phenomenon. And, it was just interesting to me.
Fair enough. So that curiosity led you down the rabbit hole to keep you digging down the rabbit hole, let's say.
Yes. Yeah. And I continue to find new rabbit holes, but I always have to look at it and say, how is this going to help my current style? Or is it going to hinder my current style? Is it going to take away from my current style? So you can get too many buckets of information that you're trying to haul around, and you got to figure out what works best and what resonates with you.
I'm really glad you brought this up because I want to echo it directly, and it's something I've said so many times, and I'm glad someone else is saying it too, is this idea of, I think curiosity is one of the most powerful drivers that we have. This whole platform for me that I built is because I was curious to have these kind of conversations. Even trading for me I had a path of being a dentist and university, and curiosity drove me elsewhere. I think curiosity can... in general, people don't have a passion. I think people are not born with a passion for the markets, but a passion is developed through curiosity, and that curiosity, those embers, turn into a flame of passion when you start to fulfill your curiosity and start to get better at something, and it becomes that positive feedback loop. Getting into the things you were learning specifically and what was driving your curiosity, as you mentioned, Fibonacci and so forth. What kind of advices would you have to someone that is like, I know Fibonacci, I know these things. What was the difference between surface level information and an applicable strategy? Kinds of get into what was an ideal trade model for you, or how would you approach the markets from strategy to an actual execution?
Well, so it's interesting from the standpoint that I think every trader is unique in the perspective that not only do you have to find a strategy, you have to find a strategy that works with your lifestyle, with when you're available to trade. What time frame are you going to trade? What hours of the day are you available? What markets you're going to trade? And so I had to find something that I felt like would set up relatively quickly every day, because I still was holding down several other businesses and couldn't dedicate all day to trading.
And I guess neither was it your desire. You wanted to just make your money to get back to the business.
And so there was I'm a levels trader. So if I can draw a horizontal line on a chart, that's a level. So support and resistance, Fibonacci, the previous day's value, the initial balance, the opening range, those are all things that I watch very, very closely every single day. And there's really, the way I trade today, there's really only 2 trades that I ever really focus on, and that's a previous day's value area play, and that's the initial balance play. Those are 2 trades that I watch every single day.
So previous day value, I'm assuming that means a form of the average day of yesterday, or is it highs and lows of yesterday?
So I take every night, I mark off a chart, and I take the previous day's value, and that value is where 70% of the trading took place. And I
from a volume perspective.
Right. I draw a block on the chart that says here's where the previous 70% of the previous day's trading took place. When if price opens outside of that value area and it moves into that value area on a 5-minute chart, I wait until a candle establishes in that value.
Okay.
And if it establishes in that value, there's an 80% rule that it's going to fill value. So if you're coming down into value,
you sell it off.
Establishes and sells off, there's an 80% chance it's going to fill to the other side of value. If it comes up into value, 80% rule is going to fill to the top. That's one of the trades. So that's
Very
an 80% statistic. And Jim Dalton teaches that. And,
that's very interesting.
And from a market profile perspective, it's very interesting to look at. The other trade is the initial balance. The initial balance is the first hour of trading.
Okay.
So when the first hour has happened on the day, I have 2 lines on the chart. I have the IB high and the IB low.
Of that initial hour?
Of the initial balance. So that's the initial balance. When price comes back up and tests or goes down and tests the IB low or tests the IB high, there is a 90% stat that says it's going to reject it.
So essentially, when you've defined that range of the first hour and then it comes back to test it, you just sell it at the open, stop loss at the high, and
there's a 90% chance that it will reject it on the first test, not second test, first test.
Okay, let's explore both of these.
So out of the dozens and dozens of prop firms that exist in the whole space, who can we really trust? Whether they use slippage, whether they use types of drawdown, unrealistic trading conditions, every single prop firm has hidden tricks. So after thorough research and speaking to a lot of traders, Alpha Capital is definitely the best prop firm in the space. So apart from their no commissions, low spread, no slippage, great reputation, never denying a payout, because you are a Titans of Tomorrow viewer, you get a special discount on every evaluation just using the link or using the code TOT for Titans of Tomorrow.
So the first one is the 70% of the volume of the previous day. You mark it out as a point of interest or area. First of all,
it's a value area block,
That's let's say on average, the average daily range as a proportion to the range of the 70% of the volume. Typically, what have you found that is a ratio? That the 70% of the volume is usually a 10% of that ADR, or is it usually a 50? Just to kind of know how big that zone usually is.
The zone varies dramatically. There's days that zone's extremely tight. There's days on a strong trending day, if we had a lot of volume and it was a strong trending day, those value areas can be a 200-point range. Those are days I love. Because
so you prefer the big zone ones because there's more room to trade.
Especially when we open outside of value on the next day. Because when we open outside of value on the next day and we move into value, that means that the value area play is in effect. If we open inside of value, that typically means a chop day.
I see.
So I really want to open outside of value, watch action move back into value, and then take the value area play.
And the second model, which is kind of like the range and then tap and go, have you found that you can tap and go and then use the first model as a zone that the 70% volume where it's magnetized towards, so you tap and go into the zone and then use the closure of the zone as your final take profit?
You can, absolutely can.
Okay.
And so on the value area plays, I'll give myself a little bit more room on those because I'm more confident in that. I mean, there's an 80% probability it's going to fill. There's a 90% probability on the IB trade. Okay. And so what's interesting is I have an IB indicator that plots it. I use NinjaTrader as my platform, and I use a Trade Devils indicator that plots IB for me on my NinjaTrader. And it has a stat down in the corner that tells you how many times that trade works over the previous weeks. Okay. It's alarming. We're talking it's 80-90% of the time it works. Now, it's not that it's going to be a rejection and it's just going to trend the opposite.
I understand. It might just be a move,
but
bounce and go.
On NQ, if you can pick up a 10-point wick, that's a great trade. It's a great trade.
I want to explore exactly this because reactions don't necessarily lead to the market moving and reversing in direction, but that tap and go, catch a small amount, and the rest comes to break even. As we mentioned on stage at the summit, there's no cost of breaking even.
That's right.
You can hit break even all day.
Yeah.
So I'm actually aligned with that. I'm doing certain things, I'm doing a difference, but with a similar philosophy of sharp stop loss, go for the volatility of the day, go for the session movement, and be in and out quick because you're playing the risk reward game. So I want to first start off with the risk reward side of things, because you're mentioning there's a super high probability of reactions and potentially reversals, let's say. But I want to understand, with what parameters do you decide to execute? Because number one that comes to mind is with the degree of variability between that 70% volume being a large zone and sometimes super tight zone. And you mentioned the larger ones is the ones you prefer. How do you qualify which one is a tradable moment? What are the parameters you're adding on to make, let's say, this trader that I know has a high reaction rate a worthwhile rate for you to still enter? Or was it almost an everyday thing?
So what's interesting is everybody talks about risk reward, and I've never I don't know as I completely understand every style of trading in that regard. I don't look at risk reward from a 1 to 5 or 1 to 4, any of that. I look at it in terms of dollars and ticks. I come from the retail business, so if
do you do fixed position size?
I do fixed positions. So
okay.
I enter most, and I also say this, everybody looks at it and says, I run a 100-point stop, for example, someone may say. And I ask them, why do you run a 100-point stop? Well, it's because that's their risk tolerance. I always look at it and say there's another factor to what stop size you should run, and that should be based on the confluence that you drew up to take that trade. If you spent the time to draw the proper confluence, you can probably run a lot tighter stop on that entry. If you just drew a couple lines on a chart and said, I think if price gets here, I'm going to try this, well, then you're going to probably have to have a bigger stop. So my stop sizes are driven off of the confluence that I started drawing up, because my trading day starts when the market closes the previous day. I start drawing up charts the previous day. And so the more time I take on drawing those charts up, and the more time I spend identifying levels that I want to trade on the next day, the tighter my stops are going to be. Because I'm more confident in those levels. I don't want to risk a lot more.
But when you are more confident, do you size up, or is it always a standardized?
I scale in, I never DCA. I will. So in the last couple of years, I've been entering with one contract and then I scale in. And that was a little bit difficult for me to do because there's many times that I want to jump in with 3 or 5 contracts.
I see.
But what I started to do was enter with one, because I can give myself a little bit more room if needs be. And so I've typically run a 50 ticks stop on NQ, which is pretty tight. And I've been able to maybe expand that a bit because I'm only doing one contract. So then I like to scale in.
When you are scaling in, does your following position only come when the initial is break even?
So as soon as I can get a stop at break even, I do that, because I'm willing to get stopped out 100 times. Like I said,
it makes
no
sense.
one penalizes you for getting stopped out, right? Because if you're not going to be wrong 50 times on the day, you're going to get something out of it, right? And so I like to get the stop into profit as quickly as I can, but then I trail with confluence. I move stop as price moves through other areas of confluence that I've identified. But what's interesting about the stop, because I get this question a lot, stops, I like to use an analogy that stops are a little bit like American football. So let's pretend the stop is the pocket.
Okay.
Let's pretend you're the quarterback. The offensive line is break even. So the ball snaps, you're in the trade. Quarterback, you're the quarterback, you got the ball. You're looking, where's this trade going? Where's it going? What do I do? What do I do? You're in the pocket. The offensive line gets broke. They're coming after you. It's best just to go down in the pocket. Don't step out of the pocket. That's your strategy. That was where you entered. That's where you were comfortable. Just go down in the pocket with the ball. You didn't lose more than your strategy.
Right.
You stayed within your rules, and you can take another trade. Now, another analogy. That same thing, ball snaps. Quarterback's got the ball. He's getting pressure. They're coming after him. They're going to sack him. He steps out of the pocket. Let's pretend that pocket was a 5-point stop. But he steps out and he backs up another 10 yards.
Yep.
You're another 5 or 10 points down, right? They come after you, you get sacked. What happens? Now you're down 3 times what your strategy was. You just broke the rule. And if you always think about that, you got to stay in the pocket. Right. The second you step out of that pocket, they're coming after you. You're naked in the market, right? You're on the mouse, not knowing what's happening. You're in the moment. Emotions are getting a hold of you. You can't figure out why you weren't right, and you're just pulling that quarterback back.
Right.
You're just pulling him back.
Making it worse and worse, yes. So the reason I kind of started off with the risk reward one is it's usually the more common approach, but I'm completely aware that there's two ways to do risk. One is the fixed position size, and then you just add up your plus or minus ticks, and that's kind of your P&L decision making. And then another one is the risk reward parameter. I find the people that do the fixed position size usually trade only one asset class or maybe two and have their fixed position size on each. I want to question this one because this is a decision I had for myself also. I chose to modulate my lot size and position size to always standardize my risk in a dollar amount. But if I have a X tick stop loss versus a bigger stop loss, I want to lose the same, let's say $1,000. But in your sense, if you're doing fixed position size based on how big your stop zone is, certain trades you may lose more money than other trades. And I guess that it balances out at the end of the month. But when you don't have a fixed loss per trade, does that have any effect on the mind to say, well, this trade I might lose 1,000, this trade it has a larger stop loss, I might lose 1,400. That non-standardized risk elements not amplified by more confidence in a trade, therefore sizing in rather it's just it was a bigger or smaller stop loss. How does that affect your system?
Well, like I said, typically I always enter with a 50 tick stop. And so,
okay, so that is like a hard rule, or is based on the price action and some parameters?
That's pretty much a hard rule. So
with a bit of breathing room. Okay.
The only time I might flex on that a bit is if I'm entering on a value area play, because that's a high probability play, or the IB play, because that's a high probability play. But if I'm entering off of other confluence, fib confluence, unless it's off a really high time frame that I've identified, then I might give myself a little bit more. But if it's one of those things where I only have 3 or 4 things of confluence and it's not those high probability plays, then I'm going to enter with a hard stop loss of 50 ticks, and I don't change that. I'll let it get hit, and there's many times I'll exit the trade before it hits, because you kind of get that uncomfortable feeling. You're not liking the action. It didn't move quick enough off the level.
Yes.
Right? And so if I start seeing that, then I just close the trade.
Okay, so in that sense, you have fixed position size and fixed stop loss amount.
Right.
So you're always losing the same amount when you take a loss.
Yep.
Okay, that makes a lot of sense.
And go back to the football thing. What do they do after every play in football? They huddle. Why do they huddle? They're re-strategizing, coming up with another play, right? They run another play. And if you think about trading from a football perspective and apply a lot of the same things they do, it really does help change the game a bit, because every trade, win or lose, you should analyze, right? Take a step back. What happened? What did I do right? And if you on the value area plays and the IB plays that I do, if I lose those, it honestly it doesn't bother me, because there's if I follow the rules of entry,
yes,
I dismiss it very quickly.
I think that's a wonderful message to have, because a lot of traders, in fact, even at the summit, I'm going to say this example again. I met a gentleman, and he was confident that his technicals were great, and he was just coming up for some help and advices on his psychology. So I asked him some questions on his strategy, and he was like 7-8 trades a day, doesn't use a stop loss, and it just felt like a very chaotic approach. Yet he and many others scapegoated towards their psychology. But when I see a lot of great traders in front of me, what I always seem to find is they rely on their data, they rely on their edge and a bit of exposure, and they get used to it, used to the feeling of being in a trade. Psychology often will take care of itself, because if you have firm belief in your system, a loss is just another day in the office, rather than you have to have these mental frameworks on how to deal with a certain emotion. Like I think there's more practical approaches to psychology.
But the great Peter Tuchman, who the Einstein of Wall Street, he said it best at the conference. He said, if you're using mental stops, you're mental.
Yep.
That resonated with me, because mental stops, I'm a firm believer in trading that if you don't have it written down on paper, first of all, you need that strategy written down on paper. You need the rules of entry, the rules of engagement written down on paper, the rules for entry, the rules for exit. It needs to all be written down. And when a trade doesn't go in your way, you should be able to instantly look at that paper and go, okay, I followed the rules, just wasn't right. Or I broke this rule.
I want to ask about a sense of objectivity versus subjectivity, specifically because I think I heard you mention along the lines of, when I'm in the trade and it's a part of my plan, and again, you're marking your chart up the night before, and then you're seeing everything, price arriving to your level, you've got in based on your parameters, now it's a valid trade for you, you've taken it, and now it's not reacting as you want, so it's not giving the momentum that you want. I think you mentioned something like that. So therefore you have now whilst you're in the trade, further decision making of, is this reacting as I want? Should I get out? Should I move my stop to break even, etc.? How much subjectivity and decision making should you have once you're already in the trade versus someone that says, that's set and forget, just you're in now, break even, stop loss, or take profit. That's the only outcomes. How much do you modify and do further decision makings once you're in?
It depends on the confluence that I entered on, but if I'm confident in the confluence and there's nothing happening, and I'm not a fundamental trader, but I do have financial juice going, so I can kind of understand what's happening in the world. Mm-hmm. And if there's something rumbling over there on the news, I might kind of try to tighten things up on my trade. Okay. But if I get uncomfortable, one of the first things I do is I'm looking for the opportunity to get that stop to break even. I do.
It seems like, based on stage and what I've heard you say a few times, is your stop loss to break even is one of the strongest bullets you have in your chamber.
I am a defensive player. I defend the downside at all costs. And that started when I was working, on the Apex Trader Funding evals. You have the trailing drawdown. You have the trailing drawdown on the PA until you get past the threshold, and you always have to be in that defensive mode. Protect that drawdown, protect that drawdown, live to play another day, right? And it's way easier just to say you're wrong. I think Dale Carnegie, he always said, he had a saying about that: when you're wrong, admit it immediately and emphatically. And the same thing goes for trading. And I think we can take some of the things that Dale Carnegie even teaches, from a social perspective, and say, we can apply this to trading. And when you start to say, okay, I'm wrong, I'm out, I'm done, I'm tapping out, enter the huddle again, live to play another day.
Why do you think that is so powerful as a framework to have of absolute accountability with urgency? Why do you think that helps traders?
Well, I think it shows confidence in your strategy, because if I build out the proper confluence the night before, and I have clearly defined zones on a chart where are areas of interest where I want to trade. If price moves outside, if I enter and it moves against me, it's moved outside of those zones of interest, I need to admit I was wrong. Just get out. Don't DCA. Don't start adding contracts. You're wrong. It moved outside your zone. In other words, if price had never got to your zone, you wouldn't have entered where you're starting to DCA at. That is not your trade zone.
Yes.
You're wrong. Just get up. And the thing is get up, walk away, come back, because in 5 minutes that chart's going to look different.
So when it comes to, I want to say, points of interest, there's various ways people can define their point of interest, whether it's a market structure supply zone, whether it's a fib level, support and resistance, a head and shoulder neckline, let's say. People always have their zones, and you've defined your own high probability zones from previous day volume and then the initial opening range. When you take a zone, obviously there's a probability of a zone, and I guess you have your data on your side, but then there's also an arm of precision, I want to say, which is your zone may be this big, but if you wait for a lower time frame rejection, you could take a zone to a pinpoint entry because you got confirmations. Let's say, for example, as simple as a doji candle.
Right.
Price comes into your zone, you get a doji. Instead of putting a stop below the whole zone, you put it below the doji. So it adds a level of precision, increases your risk reward if you're taking that route. So you've got accuracy and better risk reward on your side. What kind of models, or are you using any models beyond just high probability zones to get that extra level of precision, a sharper stop, and also maybe using as a tool to say, here's my zone, it's usually valid, but I didn't get the rejection, so I'm not going to enter. Are you doing anything with lower time frame confirmations?
I like to. There was someone that taught me Fibonacci. Mike Paragos' his name, and he always used the analogy. He said, if you have if you build out a zone on a chart and you have, let's say there's a previous day's open or close, and then you've got the value area low or high, and you got several things that are all kind of in this zone that look really, really good to you. Then you also want to look to see what soldiers you have behind that zone. So if you've got that built out, and then just behind that zone, there's a 61.8 retracement, there's a 78.6 retracement. Those are kind of the soldiers behind that zone. So you kind of want to, those are trades where you maybe enter and you maybe give yourself a little bit of flexibility because you know that it could potentially go down there and test that soldier that's backing you up, right? So you got to be a little bit careful. But I a lot of times try to draw my zones in a 50 tick range, which is my stop. So I know if I enter at the top and if it hits the bottom of my zone, I need to tap out.
Okay. I was just about to say that people have a zone and then they have other reasons below their zone that price could respect.
Yep.
And then you just find people that are just like enter here, and then they end up and then it's a bearish day and they end up losing on all of them.
Yeah, if you enter on first test of a zone, it's what we like to do. I'll set limit orders on, take for instance a value area play and the IB play. I'll set limit orders.
Interesting.
Because I'm confident in those zones.
So you have a zone, you set a limit, and do you have an expiration of, if I don't tap into my zone within X amount of time, I'll remove my limits, or you leave that limit the whole day?
Well, in value area, if price trends away from it, then obviously that play's done for the day.
So
Or if you
that was
open
almost
up,
instant,
if
that
you
one.
open up inside a value, that play's already done for the day. So you can write that one off. The IB play happens every day. You know, that's a great play that you can watch.
So were you pretty much entering on a daily basis?
I will do the IB play every single day with a limit order.
How interesting. How interesting. Okay.
And it's pretty interesting. Some of the biggest IB plays I've done have been 80 to 100 points.
Wow.
And there's been 30 or 40 points on a wick. There has been instant rejection before.
Yes.
90% probability on that one.
This is something I want to explore because I am on the side of lower time frame. I go for quick, short moves. But I used to be a swing trader. And the reason I transitioned, well, there's a long list of reasons, but one of the main reasons was based on my own temperaments. I like instant feedback. I don't want to sit and ruminate, whatever the word is, to ponder upon an idea, because I might overthink it and mess it up and dollar cost average as people do, or get out too early because it was chopping around, etc. So swing trading, you might be sitting in that entry drawdown points for a week before it trends towards your target. Whereas when you are sharp in the intra-session side, it's tap and go. And you tap and go to stop loss or tap and go towards your take profit level, but at least you found out. And that's the way I satiated a lot of my psychology. How important have you found that in your own trading of, let's say, this tap and go instant feedback and sharp, accurate plays as opposed to big zones and let the market play out and leave the screen?
Well, what's interesting is those are the plays we all want. We want those lines on the chart where the wick hits it and you're in and it's running away. The challenge that we have is that I always say that I've only traded really two instruments in my career. I've traded the S&P, the ES contract, and the NASDAQ, the NQ contract. And I've always told people, I said, ES is like the girlfriend that your parents want you to bring home.
Okay.
NQ is the girlfriend that you want to bring home. She's the wild, flirtatious gal. The ES is the more docile, humble gal. And so sometimes on ES, it's a little easier to take those trades and have those little more pinpoint entries. Okay. But NQ can, it can be a little volatile and long wicks, punch through zones, front run zones, and things of that nature. And when that happens, you kind of, you have to adjust things. But again, it all goes back to what's in that zone that you built out. If that zone's just support and resistance, yeah, it may test it and punch through it a little bit more if it's going to respect it. It depends on what's in that zone. But if you got strong daily levels or 4-hour levels that are all set in that value area high or IB high, that's a huge trade to capitalize on. Got to look at the big picture. I'm always starting off on daily charts and pulling all of those time frame levels forward onto a 5-minute chart. So on my 5-minute chart, I have weekly, daily, 4-hour, and hourly levels, all color coded according to the time frame.
When you have your ranges and your points of interest, how important is overall high time frame trend to support that zone, or is it each zone is independent regardless of its pro trend or counter trend?
When you're talking a higher time frame,
let's say the higher time frame is, let's say the daily is overall bearish, but then one of your plays is giving a bullish situation. Would you still buy in a bearish trend?
So higher time frame zones always trump anything on a 5-minute. The only reason why I even look at a 5-minute is you can kind of fine tune your entries, right? You can kind of see where the candles are at, and maybe you can draw off some other lower time frame fibs or some small support and resistance that it might be respected on a 5-minute time frame. But I enter on 5 minutes just because it's a better visual. Maybe I can get a little more granular on that entry, but I really like to pull levels off the higher time frames. It's just hard for me to trade off of an hour chart or 4-hour chart with the way I trade.
Fair enough. As a trader, it's very simple. You have to find an edge, and then you have to have a mind so you can follow that edge. But how do you know if you're performing correctly or not? You have to know your data, and TradeZeller is going to show you everything that you need beyond the surface level win rates and performance and equity curve. It's going to show you detailed reports. It's going to be your back testing tool, strategy testing tool, playbooks, notes, and it's going to be a full journal. It makes your journaling easier, faster, and more meaningful. Whereas if you were just documenting it on an Excel spreadsheet or taking screenshots on your iPhone, you wouldn't be able to pull out the data that you need, the correlations that the AI within TradeZeller is pulling out for you. There's so much variety and utility within the software that I think it's essential for any trader. So the link somewhere below is going to take you directly to the TradeZeller website. I'm not getting paid. This is for you. If you want it, if you like it, go ahead and explore it, and probably you'll be using it for years to come.
When people may be listening to this conversation, they could be thinking, if he has 1 or 2 potential valid trades per day and there is not too much lower time frame confirmation, it's more of a break-even defensive play, it seems like you would be entering quite often. And other traders that are more used to 1 trade a week, 2 trades a month kind of thing, they may be thinking these lower time frame hyperactive traders are just junkies and so forth. Have you ever felt like you were over trading, especially when you were new to the markets?
For sure.
And you just had a monetary goal. You didn't have a huge, let's say, 3 years in the making and studying whatever. You kind of just went into the deep end and started trading pretty actively. Did you ever feel like maybe it's time to retreat and do 1 trade a week and slow down and all of this? Or why was this the chosen approach?
So back in the day when I first started trading at Apex, I would buy evaluations. I'd buy 20 at a time, and I'd blow through multiple batches of 20 in a day.
Okay.
I would hit the rhythmic limitation on how many trades you can take in a day. Thousands of trades. That's how I got my start. And because I learned by getting thrown in the fire. And that was how I got introduced to it. I would just max contracts all the time. But I was actually learning the technical side quite well. I would just go in full tilt every time. And I did this time and time again. In 2021, during COVID, I was living in Taiwan, and I was trading 20 contracts on a computer with a Wi-Fi connection. These were funded accounts. I had $350,000 sitting across 20 accounts, and no brackets, lost Wi-Fi, and lost $350,000. And I was day 2 of a 2-week quarantine.
Oh, okay.
And so I had to live with that for 2 weeks. And I read everything by Mark Douglas. I went back to the Dale Carnegie. I went back to Zig Ziglar. I had to kind of repurpose everything in my mind. What am I here for? I've got to get this under control. Go back to the US and I start rinse and repeat. More accounts. And Daryl Martin, our CEO, out of the blue one day called me and he said, you're a pretty good trader from a technical perspective. Your mornings look fantastic. But he said, you give it all back every afternoon. You give it all back. He says, your entries are great in the morning. He says, you're up $1,000 in the morning. You throw it all away every afternoon. He says, just stop trading. Just stop. And hearing it from somebody else, even though that I clearly knew that's what was going on, I could see this every day, I had to take a step back. So what I did is I said, I got to start looking at a bigger picture. I got to put a goal out there that I want to get to. So I took a spreadsheet. I said, I want to make $1 million. That was a good round number, right? Okay. So I want to make $1 million. So I looked at 20 accounts. I run the spreadsheet out 6 months. I said there's 20 days in a trading month. That's 120 days of trading. If I trade 20 accounts and you break that down per day, that's $8,333.33 per day that I need to make. Spread that across 20 accounts, that's only $416 per account. That's very doable. And that's how I entered. And when I started to enter that mindset of, I'm going to make $416, and in 120 days, I'm going to have $1 million. And every day, that's what I did. Now, part of the other rules I had was I could only have 3 wins or 3 losses. So if I had 3 wins on the day, I was done. Now, there were some days, those 3 wins were only $100 or $200 because I got uncomfortable with the positions. I would pull my stop and profit, get taken out, but there was no loss on the day, right? But I would stop. That was 3 wins. There were other days where I would get the runners and I had $20,000, $50,000, $100,000 days because I caught some runners. But the 3 trade rule is something I still follow today. And over the course of that 6 months, that's how I built that $1 million. But what's interesting about that, the difficult thing for me to do was when I was up 20,000 on the day, for example, it was really easy on a strong trending day to look at that and go, we're going to trend the rest of the afternoon. So I had to start writing down what time of day I took the trades and if it was win or lose. And I started to find out that from the lunch hour throughout the afternoon, my success rate went to nothing. Like I was 96, I had a 96% loss rate in the afternoon session.
Wow.
It's pretty crazy. That's pretty crazy. And so what I did is I went and got a poker chip set, and I started to stack poker chips on my desk. Every time I had a winning trade, I'd stack the poker chips. $20,000, I'd have 20 poker chips. Have a loss, I'd take poker chips away. And seeing that visually completely changed it for me. It sounds crazy to say that, but it took that funny, goofy number on the screen.
Something you can touch and hold.
And I could sit there and look at these poker chips and say, I'm not giving this back today. You know, today I'm keeping this. I'm going to keep this. And the combination of Daryl calling me, telling me just stop trading, the poker chips on the desk, the 3 trade rule, that drove the discipline that I needed to get there.
Just hearing you speak and the analogies that you've been kind of mentioning, like the American football analogy and others, and just these little mental frameworks of have something physical, it seems like you have a very visual mind and a very creative mind. And I wonder, because you're also someone that kind of threw themselves into the deep end, and a lot of traders like to be in, let me study for 6 months, let me buy the courses and let me learn, and then let me backtest 2 years of price action, and then let me spend more time in Q&As and whatever. And they spend a year or two in just theory land, and whereas you were like, let me go swim and let me go into the deep end. With the kind of mind you have and this approach of, you know, I'm okay to blow accounts, but these are the ways I will learn. And you maybe got very quickly 1,000 trades under your belt in a controlled way, because it didn't cost you your life savings. It cost you whatever it cost for those accounts. What kind of frameworks and let's say ideas did you have to take this, I want to say, aggressive approach that usually most beginner traders are quite conservative to not jump in and keep buying these accounts right away, rather they want to learn first and then maybe in a year or two start getting skin in the game?
Well, I think for me it was the fact I had a $2 million bill hanging over my head.
You had to
so
make moves.
I was looking at that going, you know, I got to make some money here. You know, I would never suggest doing what I did. At the same time, you know, it's difficult for a lot of people to just trade sim accounts. You know, you quickly get bored with that. And I see a lot of traders, they'll trade a sim account. You know, they have some small success and they right away want to go to a live brokerage account. You know, I would never encourage that. I think that's where prop steps in and provides such a low cost way to enter the markets that we all need to capitalize on. You know, there's no reason to risk $5,000 or $10,000 of your own money when you can go out there and buy a prop account for $30 to $500, depending if you're futures or Forex, whatever that is, right? And so I think what people need to do is they need to back up, do a little bit more sim trading, identify the strategy that resonates with them, critique that strategy. I've never been a back tester. In fact, I've never back tested anything in my life. I've just watched the markets and watched the value plays and the IB plays every day and have studied that enough to know that works and built the indicators to allow me to plot that every day. And those are the trades.
There we go. When it came to a typical trader's journey, that I like to say, is usually they start off on the sim accounts and then they try to backtest a lot, build good habits, and then they like to get some skin in the game, which is usually $1,000 account deposit. They usually, like yourself and most others, blow that account pretty quickly, and then they realize, okay, prop firms are a great opportunity. But their goal is always, let me use prop firms to get X amount of payouts to then bring it back to a live account, a personal live account outside of the prop and the rules that they have. Now that you made $1 million in, and maybe even more in payouts, have you then used that to funnel it to live accounts and using that as the preferred way to trade, or is props always home?
So I actually don't trade any prop right now. So I trade Apex. Once you're successful in performance accounts or PA accounts at Apex, they move you to a live brokerage account. So I trade the live brokerage and then I trade my own personal brokerage account.
I see. Okay. And when it came to the journey of scaling your way up to that $1 million, you mentioned you divided down to $8,000 a day or whatever the number was. You have a plan in place, and I guess some days you're working towards that plan and a lot of ticks are coming in. Sometimes you have bad days and you're off of the plan. But more to say that obviously it didn't come overnight, 0 to $1 million, and there's a lot of high moments where you're like, okay, I'm 100K up overall, I'm 200K up overall. Just talk to me through that journey of how you are feeling, and when you are hitting these big day numbers or these big months where you've got a lot of, you made a lot of capital, to say, okay, let's keep going. Whereas people can get very overconfident, they can get overzealous, they can think they got God's gift and then they give it all back. It seems like you were doing it on a day basis where you were giving it all back, so you could put controls in place. But what about on the macro, let's say where you had a big month, but then the next month you didn't give it all away? So
I always looked at it I always averaged where I was at. So even if I had a $50,000 a day. The next day, that was a soft target of 8,333. So I'd always calculate every day and go, where am I at on this 6-month journey? And as long as I was super happy, as long as I was averaging that 8,333.
Okay.
And to be honest, I don't think I ever, other than when I initially started, when I first started, I was building $50 and $100 and $75 trades at a time, right? You know, those big days didn't start coming until I had moved well away from that drawdown. Because when I was in the drawdown mode, I was a total defensive mode, taking small wins. It took the first month just to get away from the drawdown. And in my case, I had $300,000 accounts, so that was a $7,500 drawdown. And I was comfortable once I got above 10,000. So I wanted 10,000 as that drawdown. Once I built those accounts to 20,000, I never actually took payouts to ever bring them below 20,000 in profit. I kept to $20,000 because I figured you're going to have that. I always said, plan for that one day that I was going to fold like a cheap lawn chair and just blow that, you know, a $5,000 trade, right? But I was always in defense mode. I was always protecting the downside, and looking at the average, saying, where am I at on the path to that $1 million payout? And I think the reason why that worked for me was, again, coming from the retail, the sourcing side, the import-export side, you know, you always have this product roadmap. We're going to get this built. Here's the timelines. Here's the Black Friday sale. Here's the Thanksgiving, whatever it is. Here's when the retailer wants it in store. Here's the shipping timeline. So that worked well for me because that was the environment that I came from. So I had to kind of pull that over to the trading side and say, what is that timeline? What is that path to success?
What was your overall, let's say, risk to reward of cost towards evaluations, cost towards your initial broker deposits and so forth versus the total amount you made? Just to kind of give people a vision of what's possible.
Yeah, it's a good question. I'm glad you asked that because everybody talks about $1 million payouts. I spent $350,000 to make $1 million.
Okay.
That $350,000 was everything I put into prop, personal brokerage.
Wow. Okay.
Everything I've spent to learn futures cost me $350,000 to make $1 million.
Now, when you look at it as like in hindsight, that was a great deal. You got a 3.
I would take that deal any day of the week.
But when you haven't got the $1 million yet, but you're spending. How are you approaching that? Because a lot of people get fearful when they're like $1 or $2 grand into evaluation, think, okay, maybe let me take a break and let me not buy some more for a while. How did you allow yourself to be rather aggressive in your costs of the journey?
I was fortunate from the standpoint that even though I had lost quite a bit on the business in Shanghai, I was also in a situation at that time where I treated it like another business opportunity because at that time, you know, in businesses across Asia, I've had opportunities all the time to join up with the project, and they go, you know, it's going to cost you $500,000 to get in on this and be a partner in this. So I always look at it from that perspective. I'm going, there's the potential to make millions and millions of dollars. So I just basically said, I'm willing to spend $350,000, and I spent every dime of it to make it happen. But I looked at it purely from a business opportunity.
It makes sense. But was that with a hard cutoff or?
That was a hard cutoff. In my last 20 accounts, I hit it.
Okay, it was to the wire.
Yeah.
Fair enough.
Yeah.
And once that $1 million had landed, was it straight to just paying off the costs and the debts you had from the initial business? Or what did you use the money for in terms of investments and so forth?
Yeah, no, so over the course of that trading, I was still running businesses overseas, and so I had income helping pay that off as well. So everything went to pay to get rid of that debt, and thank God that happened. And got that all behind me. So,
and I want to hear, the reason I ask is I want to hear life before the debt and trading before the debt, and now that you've cleared the debt and maybe the mental relief you have and so forth. Have you noticed any apparent changes in your behaviors or performance without this debt looming?
You can't. I mean, I think that's the scary part is I see so many people, they meet their lifestyle changes, and I always say, don't let success define you, let it refine you. Just let it polish the edges a little bit.
Okay.
Right? Don't let it, it's not who you are. So there's nothing wrong with going out there and treating yourself to something nice, but don't let that take over. That's not who you never forget how you got there. Right? And I think that's the most important thing. And I also want to make my story and my journey something that inspires others, encourages others. And in fact, one of the big things I want to do in my career yet, and I'm starting to do, especially across Asia, is there's such opportunity for people to get into prop, and it's such a life-changing experience. And you enter countries where, $10 or $20 a day is the income.
Yep.
That's a tick or two on NQ. And that's a life-changing experience for people. And I think I want to maintain that simplicity, maintain the humility, so that I can teach very simple strategies to people around the world.
Beautiful. I want to actually ask, because I forgot, we've spoken about risk, the break even, the entry, the zones, but we haven't spoken about the exits, the profit taking. How did you approach that? Because you also have the daily volatility on your side, you have potentially trend on your side, then there's obviously fib extensions and next supports and so forth. A lot of traders can end up with a million lines on their screens for the potential exit, and then hope and greed lets them wait it out a little bit further, or some people just exit too early. How did you manage your exits with your specific style?
So initially when I started, I had 50 tick profit targets as well.
Just one-to-ones?
As one-to-ones.
Okay.
So it hit my profit target, that was the trade on the day. And you do that 3 times. And in Q, that's pretty easy to do. 50 ticks is pretty easy to do. And that worked very well to build those accounts up. Now, the way I trade today, I typically enter with a stop loss, but not a profit target on the chart. Okay. And then I just trail through areas of confluence and look at that. But anytime, to this day, anytime I look at a chart, I look at a trade that I'm in, and I go, damn, that's a lot of money, I exit.
Okay. You use that as a guide.
Yeah.
Okay.
That's that gut feel that you really need to listen to. And there's times I sit there and I go, wow, that's a really good trade, and it's time to at least put a stop in, right?
Yes.
And protect it.
When you're going from the stop to break even, which I imagine is rather as aggressive as you could be, because you'd rather hit the break even and miss the trade than take the loss. So once you've had that very quick break even and it's slightly in profit and it starts to go more and more towards profits, and then you start to trail your stop to then eventually say, okay, if it rejects one of my zones, okay, I take home whatever it gave me. How far behind would you trail your break even and then in profit stop loss? And would you move that back up if it's in a sell, or is it just always following down and eventually it just comes back and hits it?
So the one thing I've never changed is when I was trading the 20 accounts, if I made $1,000 on the day, I protected that at all costs. Because that's 20,000 on 20 accounts, right?
Of course, when it's like that. Yes.
So $1,000, I would pull my stop into profit. I would protect that at any cost. If I made 2,000, I protected that. I moved in $1,000 increments. I would protect
amplified by 20 accounts.
Right, divided by 20 accounts. Yeah. And I still do that to this day. If I'm in my personal brokerage account and make $1,000, I protect it. But what I do different today is I'm willing to kind of let things run because I'm not actively monitoring it. And so I'll just pull my stop and profit. But if I see it spike, I'm going to trail. I don't like to get back because I'm always in that trailing drawdown mentality. And the reality of it is there's stats out there to show with prop firms that there's more people passing trailing drawdown challenges than there are end of day challenges. People tend to get in end of day challenges and just kind of let it work itself out, and they never take the profit. So they get in this cycle of just let it work itself out, and you'll see these massive runs where they'll let them go up and come all the way back down almost to entry. And they do this, it's just a cycle they're in every single day. Whereas the trailing drawdown teaches you to bank the money, bank the money, bank the money.
Well, with that in mind, do you just do the trading stop and then your full position size is taken out, or do you kind of take partials at certain levels and then the final hit is the trailing? Are you kind of like dollar cost averaging out, or just one exit?
So like I said earlier, I enter with one contract and then I'll scale in. I'm finding I really like that. And I don't know why I didn't start doing that much earlier, because I think it would have actually worked. And the reason why I started to do that is at Apex, we don't see that a lot. We see a lot of DCA, so they're dollar cost averaging down, but we don't see traders scaling into winners. There's no rule saying you can't scale into winners.
Right.
And if you're up 10, 12, 20 points on NQ, add another contract, you can still keep your stop and profit, right? You can really start
playing with the house's money of what was already made, yes.
And then in those cases, I'll scale out. I'll take one contract off at an area of confluence, maybe try to keep one on. It's always fun to have a runner, right?
Yeah, because you never know if Trump tweets, or you literally never know in the markets. I want to understand, because I'm sure you're aware of the power of swing trading and, let's say, letting these runners run and so forth. Why did you Was it the rule sets within the props that forced you to be of this instant take a profit as soon as you can and don't give it back? Or do you still believe there is power and on a personal account you would look towards having sort of swing positions? Or do you think just session movements, do the one-to-one, secure what you can get, and then live to fight another day is a superior approach?
Oh, I like the swing trading intrigues me, but most of my trading career, trading futures, has been under the Trump presidency, where you had the volatility swings when he was tweeting in in the evenings and things.
Can't
right?
predict that as a swing trader. Yeah.
So that wouldn't work, especially there's that hour that it's closed. The futures market's closed, and I don't like to have anything setting out there. So I'd prefer to be all cash at market close. And so now coming into his second term here, I'm probably not that interested in swing trading right now, but it intrigues me from the standpoint that there are a lot of times where I've entered positions where I wished I would have held on to them, So
it's the power of hindsight, I guess.
Yeah.
What about the use of fundamentals, news releases, and certain news release as a catalyst? How are you arming yourself with that?
So I like to be aware of the news, but I don't trade the news. So I will not trade FOMC. I'm flat on all red events of any kind. And I'm not a fundamental trader, I've always said fundamentals are the catalysts that move it to technical levels on the chart. So if I'm in a trade and there's some small breaking news, I like to understand what it was and move a stop accordingly. But even then, on a live brokerage account, when you're not trading paper, you got to be careful because the stops are going to be run. Depending on what that news is, stops are suggestions when the market starts to run, right? Yes. There's got to be a buyer and a seller. It's an auction. If there's nobody there to take the other side, you're going to be left holding the bag.
You mentioned that you had heavy reliance and probably contributed towards your success of the 3-strike rule, I want to say, of whether it was a win-loss win, win-win-win, loss-loss-loss. After 3 trades, you're kind of done. I feel like on most days it's easy to follow that plan, but the days where it counts is the challenging times to adhere to it. When you're 3 losses down and you want to make it back that day, or you're on a winning streak, on a hot streak, and you want to just ride that wave and so forth. How did you take a rule, and a lot of people have their rules, but then adherence to the plan and following that rule when it counts, which is the challenging moments? How did you actually stick to that plan?
When you have 3 losses on the day, that's when you really have to sit down and do that football huddle and go, well, why didn't it work? And you have to identify why it didn't work. If you don't take the time to try to identify why it won't work, you're just going to do it again. You're going to enter that insanity phase where you're just going to think it's going to keep working. So you really have to identify why didn't it work? Did you follow your strategy? Did you follow your rules? And if you did, then the market, you just weren't right on the day. Whatever it was, had a late night. There's all kinds of things that can impact that. So you have to study that. Over the course of 6 months, I had hundreds of losing trades, lots of losing trades, but I had 3 losing days.
Oh wow!
Yeah.
Meaning to say, when you went red, did you claw back on the day?
There were times that I went red and I clawed back on the day.
Beyond your 3 losses.
But there were only 3 days that I ended the day red. I walked away from the charts red, going, I got to stop.
And those red days, was it you cut yourself after 3 losses or 3 trades?
3 loss or 1 loss if there were because there's times, it's not like over the course of 6 months, it's not like I didn't break my own rules, right?
Of course, yes.
There were times where you'd enter another contract going, man, I believe in this zone. Like, why is it not sticking? Why didn't this work? So then you would DCA in, you'd add another contract. So those certainly happen. But the one thing I didn't allow myself to do is $1,000 loss on the day I was done. Because I was $20,000 loss. So that only happened 3 days.
When it was payout time, was it all in one big wire, or did you take increments out?
So this was back at that time. Apex was only doing monthly payouts, which was interesting because now we're doing 8-day payouts. 8 trading days you can request a payout. We do that because that's what traders want. But sometimes I don't think traders understand what's best for them. The best thing for me was the monthly payouts, because there was no urgency in trading 8 days to try to get the payout. So it was 30 days. So the first 30 days, I don't believe I even took a payout because I wanted to keep my accounts over 20,000. So the first time I got my accounts over 20,000, I took one payout, and then I believe I had another subsequent payout after 30 days, and then I run it clear to the end and took an $800,000 payout. So over the course of trading at Apex, I pulled out around 1.2 million.
Mm-hmm. I want to mention a shout out to your son. You mentioned he's been watching the show,
yes,
and I'm glad to hear it. But what is your advices to your son, who's an up and coming trader, I imagine, by being a viewer, and how you're kind of advising him to navigate the markets?
So it was interesting. Just before I came on the podcast, I was giving him some coaching on trading, because he's in the prop firm space and he's trying to trade and he's attacking the discipline thing. And so, you know, I think the best way to educate up and coming traders is you got to give them example, make it real to them. And I like to give the football example. I like to do the poker chips thing,
mm-hmm.
you know, because if you just simply tell someone, just write your strategy down, write your rules down, and if you have three losing trades, just walk away. It's easy to say that. It's difficult to do that. Mm-hmm. But if you put it in terms of what interests people, it's a little bit easier. Don't move out of that pocket, you know? Mm-hmm. Don't be the quarterback running back, right? You're going to get sacked and you're going to lose another 10 points on the trade. Mm-hmm. So, and he's studying finance at K-State, so he's wanting to enter this space. This mm-hmm. is squarely where he's headed, so it's going to be an interesting journey for him.
I'm curious to know that majority of people that get in, maybe including your son being in the younger generation, they see the markets very heavily tied to social media and
yes.
the mystique, the lifestyle, the everything that can bring to the table. Whereas yours, it seems like, was not social media driven. It was a practical decision, and therefore your whole orientation and beliefs and so forth were different to the majority of the viewers. Do you think that played a part? Whereas if you were involved with the smoke and mirrors of the online flexes and so forth, do you think that would have maybe hindered your performance? And how do you advise your son to kind of navigate that social media facades of a lot?
That's a very good question. The thing that helped me is I'm not on social media that much. So I had someone ask for my Instagram account yesterday, and I have no posts on my Instagram account. And I think early on, and even more so now, I was intrigued with how everybody was gamifying this whole space. It just felt like to me nobody was taking it serious. And I'm going, this is a real business opportunity. Mm-hmm. You know, if I came to you and said, you invest $350,000 and I'll return you $1 million in 6 months, what are you going to tell me?
Oh yeah, absolutely.
And at the same time, there's so much on social media that makes it feel like it's fake. It's not true. It's attainable overnight. And that's not what it is. That's not at all what it is. And I don't like what social media is doing to this space. I think everybody needs to take a step back and start to go, this is a real business. Treat it like a business. Educate yourself. Get a 4-year degree on it before you enter it. There's nothing wrong with that, right?
What is your views on, let's say, the ethical side of the industry, I want to say, where a lot of the props and a lot of the brokers and a lot of the educators, they're kind of relying on the demise of the uninformed trader, where we know the stat of brokers, which is 90% of traders blow their accounts within 90 days. That's kind of the going stat. A portion of people could say, well, each individual is responsible for their own actions. Other people could say, oh, the industry is, because there's such lower barrier to entries, there's no qualification requirements, that you're inviting in these uninformed people that are sold a dream on social media and kind of worsen their life situation. But then yourself, who kind of used the opportunity to its full advantage and kind of made a wonderful return out of it. I want to hear your thoughts on the macro, on the ethical side of the industry, and the responsibility of platforms and also the responsibility of the consumers, to make sure as an industry we are all uplifting.
Well, platforms do have a responsibility. I think as we've talked before we got on the podcast, there's regulation coming to the space. I think it's good and I think it's needed. What that's going to be and what that framework's going to be, it's anybody's guess at this point, but we know it's right around the corner. The reality of it is prop has introduced the ability to trade to people that probably previously would have never entered the space, because the barrier to entry was putting $5,000 or $10,000 in a Robinhood account or a TD account and trading that. So now that barrier to entry is dramatically lower. I think though that prop firms, the rules need to be structured so that there is a clear path to live, that the rules need to be what the same way you would trade a live account. And that's what we're doing at Apex. We have very clear written rules that if you follow them, if you follow the rules, you will be successful. It will work. You will build those accounts. You can take, and we do. We have traders that spend $30 on a 50K account, and they take that $30 and turn it into 100,000. That has happened. And so for as many use scenarios as there are that hasn't worked, there's a lot that have. We have traders that, you know, spend $5,000 and turn it into 250,000. That's happened. So there's traders that we've had many examples at Apex where we've had traders that were homeless, that went to a Starbucks, traded on a laptop computer, right? Bought a home, bought a car, put their kids in college. You know, we have a mother of 10 that's putting her kids through college on Apex. You know, those are chilling stories. And so for as many instances as there are where someone maybe is overspending, is a little overzealous in what they're doing, there's scenarios where it's quite the contrary.
Yes.
You know, it's worked. It's brought a better life to people. And that's what we got to capitalize on. That's what we got to grow.
Yeah. As we wrap up the episode, I want to take this opportunity as someone who's very well accomplished, not only in life, but actually seized the opportunity of the markets and really made phenomenal returns that only most could just aspire to have. Just some final advice that you think would be really applicable to the viewers that are usually up and coming or maybe even struggling traders.
Well, I think, and I mentioned on earlier, don't ever assume someone else's strategy is going to work for you. Find something that you're morbidly fascinated with, whatever that is. And there's plenty of strategies in trading that work. And my strategy is just one of them. I like simple things. I like simple trades on the day. And find something you're interested in and then just study the hell out of it. Know it top to bottom. Be able to talk about it. Be able to teach it. You know, I always tell people, you know, when they ask them about their strategy, I go, could you teach it? And they go, no, I couldn't teach it. And I go, well, then you don't know your strategy yet. You need to be able to teach it to someone. That's when you truly know it. And then, you know, stack the poker chips. Do it early. It's going to help. Those are very, very simple things. And don't ever leave the pocket.
There we go.
Stay in the pocket.
Man, I really enjoyed this episode, Vince. And I want to say also shout out to your son. Thank you for being a viewer, subscriber, and many that are. But primarily to yourself for making this wonderful episode. I truly enjoyed it. Thank you very much.
Thank you.
Boom.